All right, good morning, everybody, and welcome to Blocksburg 22. We're really excited to have everyone here today. And just to get us started here, I'm going to have a quick, brief opening remarks, but try to make sure that we save as much time as we can for Christian and I's discussion here to kick off our conference. First off, just want to welcome everyone and thank everybody for coming out to the conference today. We're really excited to have some great discussions on quite a few different aspects of blockchain, including cybersecurity and how it's related to on-chain assets, how taxable assets and accounting is affected by blockchain, CBDCs, and the future of where cryptocurrencies are heading. So we've definitely got some great sessions. Encourage you to stick around for all of the stuff that we've got going on today. A couple of quick thank yous that I just want to get out there for people who've helped out with the event or helped us with funding. First and foremost, I want to thank Block One and Go Virginia, who fund the work that I do. That includes Blocksburg, but also our certificate program, the boot camps that we've got running, and the webinar series that we do. Also want to thank some of the people who've been a part of our steering committee and some of the planning for this. Megan Wallace at Link, Shelly Jobst and Brianna Blanchard at CPE, and some of the other people from our steering committee not from Virginia Tech. We've got Mark Woods at Block One, Aaron Bertram at RBTC, Janice Jock with our office, and David Loudon, who's been our student representative and helping us include the perspective of the blockchain club. So a couple of quick logistics just to kick this session off. First off, this link to the webinar allows you to come in and out of sessions, and I encourage you to stick around for the full program. But if you need to run off to a meeting or something like that, this will allow you to come in and out of sessions throughout the day. Second, we're also going to be posting all of the recordings for these sessions online. So if you want to come back and check out a session that you might have missed, we'll have those available in the future. Third, we've got an extra session that we've added here in the last 48 hours or so. So at 1 o'clock, we're going to have students from our Virginia Tech Blockchain Club and also students from the Virginia Commonwealth Blockchain Club. And they're going to be talking about how blockchain education is really important, some of the projects their clubs have been doing, and also looking at some ideas about where the future of blockchain is heading from a student perspective. So definitely worth a check out there at 1 o'clock here today. And then with that, I think we can go ahead and get started with our session here with Christian today. Christian, thank you so much for being a part of our first session here this morning for Blocksburg.
Thank you very much for having me.
Yeah, absolutely. We're excited to have you. Just a brief intro for Christian. He is a senior manager at Cohen and Company who focuses on risk assurance and advisory. He is a double Virginia Tech grad. Do I have that right?
Yep. I did undergrad and then did the Master's of Accountancy. So I got my 150 hours, get that CPA done.
All right, excellent. Well, we're glad to have you back, and a Pamplin grad being on our first group is great to have you here. Christian and I actually met through some kind of hilarious circumstances. I was a guest on the Guardian Football Weekly podcast, and he reached out to connect, and we got talking. My mom's actually an accountant, so we started thinking about how some of these on-chain assets are being developed by the IRS and auditors and things that are kind of happening with all things accounting. So it was definitely an interesting way for us to get started, but definitely some interesting discussions. As a policy guy, I think the newness of these things and how that are happening on chain, and also just kind of the lack of clarity about what digital assets and cryptocurrencies and NFTs need to be treated as, is a really interesting and often neglected discussion. So thanks for being here today.
Yeah, absolutely. It's sort of cutting edge stuff. It's brand new. It's pretty rare as an accountant that you get to do something that's not been thought about at all, ever, totally unconceived. Everyone has to make it up as we go along. We don't really like that as accountants, but that's where we are.
Yeah, with a parent who's a CPA, I know exactly what you mean. The regimented systems of kind of making things happen in the very strict protocol frameworks and stuff like that is definitely on the mind of everyone. And also, thank you for joining us on Tax Day Eve. I guess since it's on a Friday, it's technically not until Monday, but
yeah, I'm not a tax guy. exactly myself, but I work with a whole bunch of them, and I talk to some of them to get ready for this, and I've been exposed to it. And as a lead into that, I'm not a tax professional. This is not tax advice, but I'm just trying to give some broad strokes, and I give some folks some information so they can better look into the tax implications. But it is not my primary focus.
Excellent start for sure. I had that on my notes too, is to say, this is not tax or investment guidance. We are definitely just kind of talking about kind of how this is operating and some of the kind of ways that this might go, but certainly do your own homework if you're going to be filing your taxes or any other kind of aspect of investment. So good thinking out. So, let's start off with a brief kind of discussion about, what the scope of your work is and some of the things that you've been doing in relation to blockchain in the past couple of years. Just walk us through some of the things that are interesting about the dimensions of your work.
Sure. So Cohen and Company, the office I work in is in Hunt Valley, Maryland, and we had historically worked with hedge funds for a long, long time, doing audits and tax work and working with those families that run hedge funds. And so when this asset class sort of became more popularized, 5, 6, 7 years ago or so, it sort of was a natural progression for us to move into the alternative investments, or we were already in the alternative investment space. And this is clearly an alternative investment. So we started off getting exposed to some of the folks who were trying to start funds. We're trying to, have entities that were based on operating in the digital asset space. And so it just grew from there. One of our partners met someone. He said, "Hey, can you help us?" And he said, "Yeah, sure, we'll take a look at it." And we started doing as much as we could to learn about what are these digital assets, what are cryptocurrencies, how are people accounting for them, what is the implications of all the impacts, from a financial statement gap perspective, generally accepted accounting principles, how is the IRS treating this stuff? And the simple answer is there wasn't a whole lot out there. And so we've been helping to develop that over these last several years, trying to get more guidance, more information for people, and it's grown too, right? At the same time, I think we really got going 2016, 2017. So we were right there on sort of that first really big wave coming through. And I think at first people were like, "What? We're going to work on these, Bitcoin? What is it? How does it work? Is it really, do people really use it?" And now clearly, it's become something that's here. I think it's here to stay in one way or another. And we've been able to sort of be there in the front line and help figure it out. We've worked with the AICPA, we've talked to the SEC, we've gone to, my colleagues have gone to Washington to speak to the folks there, trying to figure out, how can we make this the best system? What can we put in place to make this everything for digital assets more useful and make more sense for people and make sense for what digital assets are?
Yeah, so taking the kind of thread there and pulling on it a bit, could you maybe just on a couple of things, could you talk about what digital assets technically are? Let's maybe go with cryptocurrency as like the first one, but maybe we should even get as fine as saying like Bitcoin, Ethereum, and then let's also kind of throw in NFTs. Like as an accountant and somebody who's preparing a taxes, like how do you treat those assets and what do you consider them to be?
So from a tax perspective, talking to my colleagues, there really isn't much guidance from the IRS. The main piece of guidance is IRS Notice 2014-21. And so that came out in 2014. That's pretty much what we've got. And basically what it says is any of these things are property. It's just like any other piece of property. So it gets treated, you bought a car and you held it and then sold it, and whatever gain you got on it, or if you exchanged it for another car, that's a taxable event. And so any of these, whether it's NFT, Bitcoin, Ethereum, a stable coin, right? Something that you think is straight up backed by a dollar, even though you don't necessarily know exactly what's in that account that's backing it, but generally speaking, it should be tradable for a dollar. All those things are just counted as property. And any exchange between one for another is a taxable event. So if you took dollars and got Bitcoin, you purchased a piece of property, so now you're holding that. If you take that Bitcoin and exchange it for some Ether, that's a taxable event. There is some gain loss on it, right? So if you got some large gain at the end of the year on that transaction, you need to report that gain when you exchanged Bitcoin for Ethereum. So you should hold some back to make sure you've got cash to pay the taxes on that gain. And then vice versa, if you and you can offset with losses. So if you made one transaction you made a big gain, then you made another transaction that had a loss, you can offset them. But it's all treated just as property, but at the same rules as any other any other asset you might purchase for tax purposes. So it's not particularly nuanced yet.
Yeah, I was going to say the idea that something, especially for a space like blockchain, that truly is almost completely novel and just kind of building from the ground up. The idea that the guidelines that you're still using come from 2014. It's laughable might be the word. I mean, it's really the idea that basically Bitcoin, I think, would have been the only cryptocurrency at that point in time. I don't think Ethereum would have come into play until like 2015 at least, or something like that. So yeah, some of the like major assets weren't even in play. Let's kind of keep it around that space and say, what does the new Biden executive order mean to your industry? I know that there's kind of been, it's a loosely and kind of ambiguous signal that the Biden administration has sent, but it does seem that it prepares places like the IRS, places like the other kind of acronyms in the financial sphere to start to address blockchain, what it can mean, and maybe provide some more definition past 2014. Is there anything that you've been doing to either prepare for that executive order, or are there ways that that's become kind of important to your work?
Well, I think what it does more than anything else is it sort of raises the flag and says, hey guys, we need to pay attention to this. We need to start thinking about it very seriously. We need to start, any sort of legislation, we need to get it moving. We need to really put some effort behind it so that rather waiting another 6 years or 7 years, whatever it is, to get something out there to create a framework around these assets, we need to do this much sooner than the timeline we're on. It doesn't, specifically name anything, at least to my knowledge. But for us, it's meaningful. Like we're sitting on groups with the ICPA, trying to help set accounting guidance. Also, again, lobbying groups in Washington saying, hey, this needs to be done. We need more clarification. People need more information to better inform themselves on the transactions that they're entering into, and what do they need to be tracking? How much information do they need? And really sort of light a fire to get everybody to start coming to more of a consensus and get some laws on the books. And then you can, you have Coinbase, right? They're now a public company, which is a big step, but there's all kinds of stuff flying around out there that doesn't really have any regulation. And there's certain pieces of digital assets that you can't, as a US citizen, you really can't buy because they don't want to sell it to us because they don't know what the framework, they don't know who's going to come after them. They don't know what they have to do to be properly registered and regulated, what people are going to expect of them if they're going to offer that product to US citizens.
All right, good deal. One of the things you and I talked about when we were prepping up for this was a couple of hypotheticals and just kind of walking through, what you might do if you were kind of considering this. And, one that I found kind of interesting is, let's say you bought a Beeple NFT in its original drop for $1. And it's now listed on Nifty. Let's say 10 of them were sold and the other 9 are listed on Nifty Gateway for an average of $150,000.
Yeah.
But you want to list it for $1 million, but end up selling it for 120K. How does all of the different kind of price points and the lack of a closing price, let's say, of, the way the US stock market would work at like a 4 o'clock, everyone can agree the price of Google is $1,028.93. I guess the hypothetical I'm posing here is you have a lot of price points, but none of them are really particularly vetted by anything that might stand up as a viable accreditor of what these actually cost. How do you advise clients to consider what a sales price should look like and what they should claim, and kind of how that all operates?
So generally speaking, if you're going to value something, you're going to try and use the marketplace where you have transacted yourself. So like for GAAP, generally accepted accounting principles, if you're trying to value Bitcoin, you don't use Coin Market Cap, you don't just use Coinbase, you use wherever you've been transacting in that asset is how you're going to get your value. From a personal tax perspective, I think generally it's going to be something around, where did you get it? You spent $1 for it. So you're holding it at $1 currently. If there's one major marketplace, then that's the one you're probably going to point to and say, okay, here's, the last time any of these were bought or sold, that's my best place to find a number, because that's like you said, that's all that exists out there. In some cases, so we do control testing. You can get it's called a SOC report. So if you're some sort of vendor who does a lot, you can have an auditor come in and test your controls. So maybe, if you have a marketplace that has some sort of control report that's available that lets you know, yeah, they have really good controls in place to verify that transactions are well tracked, that as transactions are occurring, they're being put through the system in a timely manner, all that stuff. They're reporting to their users on a timely manner. If there's a way to know that one marketplace is maybe better than another, you probably want to use that one as your point of value. But you're right, it's just hard to know. And if you want to sell it for $1 million, that's great. And if you get someone to buy it for $1 million, then that's what you'll report it at. But until you know for sure, until you've gone through that transaction, you're just going to have to sort of make a best guess. And it's accumulating that information, whether it's screenshots, whether it's having, we have folks who have smart contracts for their stable coins. And so you can get a smart contract audited. So, do you have some sort of audit of how these things were created? And that'll help you just build that amount of information to prove what the value is. Does that make sense?
I think it does. I think one of the things that it strikes me, and we again kind of chatted a little bit about how these weird hypotheticals can go in our prep for this. It's like, what if you gift it to me? How would you establish a price for something like that? I assume quite a bit of people, and I've kind of looked at Nifty Gateway this morning to kind of glance at that stuff, and there's quite a bit of gifting that goes on there for NFTs that really are at average sales price in the last 12 months, $50,000, that are either being gifted or taken off chain. So in a space where you maybe don't have that taxable event, what kind of guidance are you guys providing?
I think you would do, again, you look at that marketplace and say, okay, here's an NFT. I've given it to you, donated to you on this date. On that date, we could see that it was worth approximately this on the marketplace. So that's what we're going to claim as what our value is. And then whoever brings it on their books will bring it on their books at that value as well. But it's also, I think, sort of up to whoever's receiving it, right? Like, do they believe it's worth that? And what sort of evidence can you provide that backs that up? I saw one transaction on one day 3 months ago that it was worth $100,000. But if you go and look today, there's only transactions that are all going for $1,000, then it's going to be hard to buy the $100,000 value, right? Like, it seems like the current marketplace is telling you something different.
Mm-hmm. Yeah, it does seem that on some level, especially without the ability to have a mediated exchange, let's say, the opportunities for someone to sell an asset that really might be worth a lot more or a lot less, there are motivations kind of in either direction as to like which way you might want to do that. Again, the taxable event, you may want to incur a loss to offset some gains somewhere else and sell an asset for way less than it actually is worth. Fidelity wouldn't allow me to sell you a Google stock for $100, but Nifty Gateway would definitely let me sell you $1,000 average sale NFT for $100. So have you seen instances where people are kind of using manipulative practices like that? Is that something that the IRS is conscious of, or is that still kind of, they haven't even gotten an executive order from the president yet? Nobody's ready.
Yeah, I am not aware of anything like that, but it doesn't mean it doesn't happen.
Sure.
It's good. And again, that's why it's sort of the wild, wild west. Has everybody conceivably thought of every way that they can manipulate this thing? Has everybody put rules in place to sort of prevent those things, right? If you're running a marketplace and you see someone post something clearly well below value, should you allow them to do that? But it's your marketplace, you can kind of do it, right? But does that make sense? Do you want to transact in a place that allows sort of very odd, maybe not realistic transactions to occur? And that's, if you're monitoring Nifty Marketplace and you see things like that happening, how does that make you feel? Do you want to continue using that one, or do you want to find another place to maybe transact that seems more on the up and up and more reliable as far as the values go?
Yeah, I can imagine that that is definitely, I agree with you, the Wild Wild West. And, also to like cover my tracks there, I'm not necessarily trying to teach anyone how to like
No,
launder money
no.
necessarily, but, and I would actually say that from an auditing perspective, you would think that a blockchain actually provides you a very crisp and clear transaction history that's almost irrefutable. It's not like a cash transaction for something and the
Right.
other kinds of ways that you might imagine something like Ozark being money laundering. It's not like the ability to have an immutable digital ledger that you can go back to and look at after some time and getting their hands around it. I think the IRS could use it as an incredible tool for actually holding people accountable for the types of things that they might do. So
No, I definitely agree. I think, it's all about learning and understanding. The only, luckily, if you have a place like Coinbase, if someone's in an exchange and it's well run, they can produce reports that show sort of that history and everything that happened. Uh, Otherwise, yeah, if you just have sort of a private wallet, Bitcoin wallet, and you're transacting in it, we can go backwards and follow in time. It's, as an auditor, it's really helpful for that. Now, you have to establish things like, do they have control of these wallets? How do you like, did somebody, if you've transacted 100 times in a Bitcoin wallet and, the way it moves is not quite the way that we all think of normal cash transactions. So it takes a lot of effort to string together that many transactions and to make sure you feel like you know where you started and then you got exactly to where you ended and then you know where all the Bitcoins in between ended up. It's quite an exercise.
I can only imagine. So kind of pivoting to a little bit different conversations, they're certainly adjacent to what we've been talking about. Could you talk a bit about privacy? I mean, one of the like core tenets of blockchain and how it operates, how digital wallets are meant to be, pseudonymous and, are almost intentionally designed as a way to create trust between actors that don't have any real reason to trust each other without an institution mediating those types of things. How does the kind of privacy features of digital wallets challenge your industry, and what kind of ways are you kind of grappling with the privacy features of some of the things that are going on here?
Sure. It's, it is nice to be able to transact and have it all out there, but not everybody know exactly who you are. That's, as an auditor though, that's tough. Usually I get a bank statement and it has your name on the top and it says who you're, you can see some details about each transaction, where it went, what you were paying things for, as an auditor or, someone who's trying to prepare your taxes. You give me just a list of Bitcoin transactions. It's hard to know exactly what happened. So it's a great functionality to stay anonymous, but for me to help prepare financial statements, I'm going to need more data then, and you're going to have to track that on your own, especially if you're in a private wallet. But even from Coinbase, they're just going to tell you how you transacted and maybe what currency on what date, what time, but it's not going to say why, right? It's not going to, generally speaking, I don't think you add a whole lot of details. You can, I think that's possible, but so that's where the users who are transacting in the digital assets need to also keep track of that information on their own. And if you're in a situation where you are doing a lot of transactions and you're going to have to report all this stuff to one regulator or another, it's the onus is sort of on you to do most of that work that maybe your bank would have done, or look, hopefully you have invoices or something that track what you were paying for. But yeah, it makes the job just more challenging. And we can't, if you don't tell me, I'm not going to know, right? I can't look at the blockchain and see any more details than basically, the hash, date and time, the two wallets that were involved, and the amount. And that's going to be it. Maybe like a gas fee you paid, but other than that, there isn't a whole lot of information out there. And
Yeah,
especially on newer blockchains, right? So Bitcoin is very well established. There's a couple block explorers, same thing with Ethereum and several of these others. But I think, Stellar is another pretty good one. But there's others out there that are newer, and it is much harder to find transactions and to track them and to pool. So on like Etherscan, I can go on, pick an address, and it has a download button, right? And it'll pull off all the transactions for that wallet address. And so that's really helpful for me, because at least I can get the information on my own. You don't have to give it to me. But there's other ones out there that don't provide that. And so I'm literally scrolling through and clicking through and seeing there's meaningful transactions every time you actually send something in and out. And then there's all the junk, right, that people try and send you on the blockchain and try and advertise to you and tell them to come and get this other weird token they've created. And we have to sift through all that. So it's much easier if you're on the more regularly used blockchains, but we've had to find ways through everything, right? Because every new token or coin is a new opportunity for somebody to make some money. So
I'm sure that it's something that oftentimes I think people are probably not thinking much about, which kind of leads to another one of those hypotheticals. The high frequency trader, somebody who's really interested in DeFi and staking blockchain based assets, most likely cryptocurrency, but certainly some people actually stake their NFTs and stuff like that. Could you talk a little bit about how staking and some of those kind of drastically high interest rates that are sometimes in DeFi challenge the way that people process these types of things? And I mean, I almost hesitate to ask you, like, have you seen a case where someone who really is high volume trading some of these like DeFi staking kinds of things where they are creating an unconscionable path of, I don't know what you call it, cryptocurrency trades in a day?
I personally have not seen that. I haven't had to work through it. I probably have some colleagues who've I'm sure had to deal with this stuff. So I am not particularly super well versed in that one. It's definitely out there. It's getting bigger. I've had some projects pitched where, they want to stake, they want to take mortgages and tokenize them and then take the yields off the mortgages and then provide those to folks. Sort of like that's like a stable coin way of doing it. But, you have, like you said, your typical staking where you sort of lock it in on the blockchain and then that's earning you some sort of more cryptocurrency off of it. It's all out there, but I'll be honest, I have not seen as much. I haven't been exposed to that.
Well, and kind of back to your original question that it's all kind of considered property. Are some of those much more complex financial instruments, like staking an NFT for 10% over 3 weeks, it's still just considered property?
So the staking is a little different and a little bit more unique. She did. The person I talked to, the tax group, definitely have seen this and they definitely had to work through it. So if you're staking and you're earning income off of that, that's ordinary income, because it's more of like at that point, you're sort of operating a business. And again, if you're out there doing this, go find someone who knows this much more thoroughly than I do. But the staking is definitely different than just holding, right? If you're just holding Ethereum and you sort of move in and out of it and buy and sell it, that's all just the property stuff. If you stake it, now it becomes something where you have you're earning income off of that digital asset, and that's a slightly different circumstance.
Sure. So one other kind of interesting facet of blockchain is that it's got an international aspect to it. It's kind of a borderless, it's built into the kind of intention of what it can be. It's a great way for you to send remittances back to a country that you might have come from. Russia and the Ukraine have kind of famously drawn up the cost of things like Bitcoin right as the war was starting, because people were actually putting some of their assets into the stabler cryptocurrencies that were available to them. So could you talk a little bit about how that kind of interfaces with like the American tax system? And let's talk about it maybe at the individual level, and then we might jump into like the organizational. Like, how does that international dimension challenge how people might operate a digital wallet or something?
It definitely adds a layer, and it's definitely happening, right? And you have different exchanges out there that only allow people, like I was saying earlier, certain nationalities can only operate in certain places. There's certain products that aren't available to us as US citizens, but maybe if you go and create an account somewhere else, you can find a way to transact in something. So yeah, we have to be aware of it. We've definitely seen folks trying to find ways to help move currency, right? There's certain countries have limitations on how many US dollars you can move, but maybe they can put them into one of these cryptocurrencies, and then that's another way to move things around. We have entities that I've worked a lot with stable coins. So we have trusts here that based in the US that back some of these stable coins, but then clearly we have them in other places. Tether is not based in the US. We've had other ones that are based in Hong Kong. We've heard of ones that want to be based in Canada or in Europe. So there's definitely different ways people are trying to use cryptocurrencies to move money around, and to help transactions go more smoothly. And I feel like personally, that's definitely one of the ways, if you're a business and you're routinely transacting in US dollars and Canadian dollars and yen and euros and pounds, it'd be a lot easier if you had one currency that you had to hold and then be able to work between all those entities and move things around. That'd be much simpler. And I think that's one of the real probably ways cryptocurrencies can be used in the future. And personally, I'll be honest, I don't have as much experience on a personal level, right? Like who individuals are holding this stuff and moving things internationally. I haven't seen that impact quite as much, but it's definitely out there.
Mm-hmm. So I guess this is a question that almost summarizes everything we've been talking about to this point. Is what kind of clarity would you like to see come from state and federal governments? What do you feel like is kind of necessary or needed in terms of making this a more optimized system that's not, backdated to 2014?
I think something that says, right now on your personal taxes, there is a box to check whether you have cryptocurrencies or not. And if you do, I highly recommend that you check that box, whether you've done a lot of trading or not. Don't say no when you actually have a private wallet somewhere, even though you think, oh, no one knows about this, doesn't exist. Definitely check the box, say, yes, you have it, because if you say no, you're not reporting faithfully, you're not being true, you're not being honest. So that's filing an incorrect form. So what I'd like to see is something that's built out more, that understands better how these wallets work, and giving people much clearer guidance on, okay, if you held something, list it out, give us your transactions, let us know, and maybe even more clarity on if you stay within cryptocurrencies, if you stay within a wallet, even if you're changing currencies, it doesn't necessarily create a taxable event, right? You have to sort of go in and out on a cash level. I don't know that something like that will come or not, but I think a big part of it's education as much as anything else, and making sure that people understand what they're entering into that moment that they buy some Bitcoin and then just start sort of slinging it around and going from that to Ether to Dogecoin to all these other things that exist out there, and raising people's awareness of you. So you've bought an NFT, what next, right? Like, what does that mean? There isn't a lot. I feel like there's some of that out there, but I think there needs to be more. From a financial accounting perspective, currently, digital assets aren't cash, so they're not listed on a cash line. They're not an inventory. They're not even, for a normal operating company, it's not counted as an investment. It's treated as an indefinite lived intangible asset. It's treated really like a piece of software. And for financial reporting purposes, right now what that means is you can't write it up until you sell it, but you can write it down. So you have a bunch of assets on the book that just keep losing value and can't actually sort of properly move with the market. And I think there needs to be some more guidance or treatment to really maybe bring it into an investment and treat it more, even though it's not exactly a stock or a bond, because you're not getting ownership in anything. You're not guaranteed any sort of interest payments. So it's not exactly like those, but that's really how it's sort of being used, right? It's more of a store of value than a piece of software. And I think that's also sort of where the IRS needs to come through and say, okay, these are clearly very unique. People need to know what they are and how they move.
Yeah, I mean, I think the industry is actually really excited about regulation. I think that was kind of something that I don't know, surprised me of sort, I guess, in the watching some of the Bitcoin Miami stuff that was happening in the past week or so.
Yeah.
I mean, even the Kathy Woods and Michael Saylors of the world kind of seem to be thinking that having the light of the federal government kind of starting to shine on them is not only just a validator and something that gives the industry a certain level of credence kind of in the world, but I think a lot of people are kind of flying blind, or
Yes.
whatever metaphor you want to mix in there, like the building the plane as you're flying it. I think the difficulty of trying to declare, is it a security, is it a commodity, is it property, and kind of whatnot. Those have actually pretty pronounced consequences, especially when you're talking about some of these 6-7 figure transactions that happen at a reasonable rate of on this area. So I definitely think the regulation side of things, people are welcoming the idea that Gary Gensler might take some action on some of this stuff and really start to call some of these assets something.
Yeah, having some regulation will open the door, make it just that much more mainstream, gives everybody a little bit more confidence, a little bit more trust that these transactions are being done in a good way, and that we can all, right? The hard part right now is you can't have Bitcoin and really transact in it day to day, right? Like you can do it on the blockchain, but to actually buy goods and services with it is still pretty difficult. And most people aren't doing that on a regular basis. And part of it is they just don't know, right? The implications of doing those transactions on a regular basis is so unknown. And where you're sort of pushed to go find the places on the internet that aren't super regulated, right? All the exchanges, Coinbase is a publicly traded company, but there's nobody really watching their exchange necessarily. There's no one coming in and saying all these transactions look like they're being done in a good way. And just a lot of these exchanges just came out of nowhere, right? Like people said, I want to create an exchange, so I will. And whether you knew a good one or a bad one, it was hard to tell. And I think that's adding a framework, adding a little bit of regulation, gives people just a little bit more confidence that they can use this stuff on a day-to-day basis.
Yeah, I do think that you're right. I mean, I think the idea that these things are denominated in US dollars oftentimes, and especially in the way that exchanges work, is they kind of create a sense that they are a little bit more structured than they necessarily are, because it's a little closer to like almost like FanDuel or something like that in terms of what you're actually getting in these things. And I think a lot of exchanges that are much more mature, the New York Stock Exchange, the NASDAQ, various things like that, have very regimented, structured, overseen, even politicized to some degree, structures for how they appoint people to their boards and how they actually create that kind of thing. FTX doesn't necessarily have that. And I think that the idea that like finding ways that they might create more, above board ways of doing that is an interesting dimension. But the fact of the matter is FTX, I don't believe, is actually even located in the United States. So
exactly. How do you regulate something that is beyond your borders? And it's set up that way almost purposely, right? Because they set up somewhere else because they weren't sure they could do it in the US. They weren't sure they wanted to try and meet the bar. And actually, if regulators were to come in, they weren't sure they were going to have the right answers when those guys walked through the door. But they do have Tom Brady. So
sure, exactly. I definitely think that there is a public perception war that is effectively going on. And while I certainly was encouraged to see all those Super Bowl ads, on another, there's a bit of a reach there that you can definitely tell they're trying to get out in front of kind of the perception kind of side of things. But that being said, I think it's even more important for the regulation to come around, because like you said, and kind of as one of the questions or one of the comments in the chat is kind of highlighting, FTX almost was put in a position where they couldn't locate in the United States because they had absolutely no idea as to what the regulatory environment they might actually be living under if the things were to change or the guidance finally came in. And to play in the sandbox, you almost need to know where the sand ends and where the box starts, and all of that type of stuff. And so I've compassion toward the companies that are trying to operate in this space. I'm going to go with one of our panelist questions, or I'm sorry, one of the audience questions that we've got coming in. This is rather specific, but I like it. If you're reporting interest earned on crypto via something like BlockFi or Celsius interest accounts, how are the gains realized? And how, after converting something like that to fiat?
So it's just interest earned. I'm guessing it came in as some other cryptocurrency. Honestly, I think you need to go find someone that has more experience with it. I mean, so clearly it came in, you've generated it, so it's income. I would compare it to other interest income that you've received as far as like a place to start. So it's probably just ordinary income. Because because that's right. Like if you had a bond and you purchased that and then it threw off interest, it would be ordinary income. So similar idea, you've taken something, you've locked it up, or like a CD, right? You took your cash, put it into a CD at your bank. It's going to send off interest. That interest is going to be taxed on your, as other interest is. So and the one thing you do, if there's ever a question, count it at the highest rate you can, and then go back and figure it out. And you can always go back and try and refile and get a refund. Whereas if you underreport, they're going to come at you and say, you didn't pay enough. And now there's penalties for not paying enough. Right. So you sort of have to make that calculated guess. Another thing is going out again, if it's the wild, wild west. So go out there, see what other evidence you can find, what other things are similar to that and how that's treated, and treat it in the same way. They may not always agree with it, but the big thing is having evidence and having a reason why you did it. The more you have to back yourself up and to explain what you did is going to help your case. It's never going to hurt you. But if you basically said, I saw a number, I saw a tax rate somewhere online, I multiplied by that, and that's what I reported, that's not going to fly nearly as well.
Mm-hmm. I'm going to ask almost a dumb question, but it's kind of obvious too. Does the IRS have a cryptocurrency or blockchain based division or something along those lines? Is that something that's in the works? I mean, how do they actually train that type of thing?
I don't know of that specifically. And again, if they're trading it just like property, like everything else, then that's, in theory, they deal in property all the time. That means all of them can handle it. They're just going to look at it the exact same way as they look at other things. I do know, so with NFTs, there's the potential for them to be like collectibles, like a nice baseball card or maybe a car or something. It may fall into that. That rate is maybe slightly different than other rates. But again, you need to really go research that and figure out, what you bought and sold the NFT for and what was the timing of that. But that's another place where maybe there's a little nuance that might help, but still you need to do the research and see what that means. But in general, I don't know of a particular blockchain group or digital asset group. And actually, so they call it virtual currency. So if you look up IRS virtual currency on their website, and I'll send you the link after this, that's where you're going to get sort of their very basic guidance on this stuff.
This is, again, a rather specific question that we somehow missed out of stuff we prepped, but I'll loop back, is the growing importance of the metaverse and how people are kind of living in more digital worlds. I don't know, it's hard to kind of approach that question from an accounting perspective, but I wondered if you had any kind of thoughts about that transition. It seems like that's just kind of the way the world's heading. I mean, you've got the Facebook rebrand, Activision Blizzard getting purchased by Microsoft. There's a lot of kind of cooking in that space. How do you think the metaverse changes the world that we live in? I guess is the question.
It adds a layer, clearly, right? So now we're living here in your house, but then you're also spending a whole lot of time in your computer out in a virtual world, and you're transacting in there. And are you transacting in dollars? Are you transacting in a cryptocurrency? Are you transacting in sort of Disney money, right? You go in and buy their money that exists in there, and how does that work? Is that actually like a stable coin, or is it right? So Mark Zuckerberg, Facebook tried to launch a stable coin. They talked about it for a couple of years there, and then they just finally sort of shut it down because I think they realized they were going to come up against so much regulatory pushback, and the regulators didn't want them having this gigantic chest of money that they were then going to put into government bonds or corporate bond. They were going to move markets with the amount of money they could potentially accumulate. And that's scary. Like, that's kind of crazy then. It's not to say that it won't happen or it never happened, but that's sort of the extra layer, right? So now you're really letting a corporation sort of absorb a lot of what's going on in the marketplace. Maybe it's happening behind the veil of that metaverse rather than out in the open in stores and things in our normal lives, how we used to do it.
Yeah, definitely. So to take off the accounting hat for a second and maybe return to our the place where you and I met talking about football, that podcast that I was on, one of the guys had just created the first football club that was based on Bitcoin. And, everything I think he purchased the club for was based on earnings he had with cryptocurrencies. And I believe that was exclusively Bitcoin. I mean, they actually were rebranding the club to become like the colors are actually gold and black as a like homage to Bitcoin. When do you think that we start to see that infiltrating certain, a DAO take over a football club? It seems like there was some attempt for the Denver Broncos potentially to be setting up some sort of a DAO to set that up. Mm-hmm. Do you think that's a viable strategy? How could you see something like a DAO operating in the world? Again, this is not you as Cohen and Co, but
it's going to happen. I think the gentleman who bought the football club, he was super Bitcoin. That's all he wanted to do was Bitcoin, nothing else. No other cryptocurrency existed to him. And I think that's interesting, being so laser focused. I think it could happen, and it makes more sense for him he's at a much smaller level, right? Like his club was like I don't even know if it was in one of the top, it wasn't even in the top.
I think they were in the 8th division.
Yeah, they're like 8th division or something. So they can kind of operate over in a corner somewhere. And until that team really gets good and moves up, no one's going to pay more attention other than that they're the Bitcoin team. But that's maybe where you can develop it, right? Because you can sort of play around, try different things, and it's not on a full national stage. For the Broncos, they can certainly try. I think some other soccer teams football teams have tried creating, fan tokens or something, and it's more of an engagement thing though than to really create a currency that people are transacting in. But it's certainly possible. I think you're going to keep seeing teams trying to do it, right? The Cowboys just came up with some, that was the headline the other day, that they're linked in with blockchain.com or something. So they're going to try and find ways if you can bring in fans, but also it generates revenue for them. And they're really happy to do it, I think.
Yeah. I mean, I guess that was the real point of that podcast, was a lot of people were kind of tearing into these like fan offered tokens to effectively create the opportunity for you to like, I don't know, pick the song music if the team wins or something like that. And these tokens were going to be some sort of a way for you to interface with the club, but they aren't really consciously thinking much about the like depths of that. That said, one of the pushbacks that I think actually got taken out of that podcast from me was something akin to trying to act like it's a Bitcoin club or even a blockchain kind of intended club when you're not going to be dismissive of things like the operating as a DAO. I find to be a little antithetical to some of the ways that I think blockchain communities really are actually hopeful of execution. I mean, decentralization and not having institutions involved is kind of, I don't know, the Kool-Aid, if you will, of what these kinds of things are built on. And I think the idea of a club that does have some semblance of a DAO as the way that they execute is a really interesting model for ways of creating fan ownership like you see in Germany, and other ways that might even get away from things like the Super League and other kinds of things that these mega billionaires who own clubs. These points of access really could be an opportunity for people.
Oh yeah, definitely. I agree. It's very much a way for sort of fans to take maybe more of that ownership and to be more involved. And the fact that maybe you can interact on your phone wherever you're at, you don't necessarily be at a computer. You can link in and be more present than having to like join a Zoom call or join a particular team meeting, right, to take a vote. You can be a proxy and not have to be quite so physically attached, but can still be very much a part of the organization making decisions. I think it's an interesting way to do it.
It is definitely an interesting way to get around that kind of like stock meeting type thing. So bring us back on the topic a touch more. Lynn asked talk a bit more about block explorers and how you use those.
All right. So block explorers are fascinating, right? That's the way we find out what's happening on the blockchain. And for the more established cryptocurrencies, they're easy to find. The great place, I don't know about you guys, I go on CoinMarketCap every day, see how things are moving around. But then if you go on there's a link for each cryptocurrency. And then usually there it will list block explorers for each one of those. And hopefully there's 2 or 3. Because it's great to triangulate information. These block explorers were just created. I don't know of any that really have any control report out there that tells me that they're a good place to actually get information. But if I can look at 2 or 3 of them and agree all the transactions across them, then that gives me some comfort that it's actually all tracking the exact same thing. Also, we, as a firm, we have third-party vendors who run nodes that pull the information off the blockchain. And so we'll compare that as well. That's how we get comfort with certain block explorers, is to compare a node that we trust that does have controls around it to the block explorer. And that gives us the comfort we can use the block explorer to get information. The best ones can help you extract information. Like I was saying with Etherscan, that one's really easy to navigate. You can really drill into transactions in particular wallets. And then there's also a way to export transaction detail, and that's always super helpful. Whereas there's other ones out there that it's just a list of transactions. So if you know you need information from 3 months ago, but there's been 2,000 transactions and it only shows 25 per page, you got to click back in the history to try and find that date. Some of them help you search better than others. Some of them help you filter better than others, but it's really a mixed bag. There's no standard for block explorers out there, and you see it pretty quickly.
Again, definitely back to the like building the plane while you're flying it. I mean, the like idea of scrolling through this 25 per page kind of thing. It feels like a AOL moment on this. It's definitely hard.
Oh, and it's funny, like we'll see them, and they've just created a token, and it's real simple. You can see how the day they created it, and then the first couple of transactions, but then it starts to mature and there's more things happening. And suddenly, the beginning of the month, the first 5 days were all on one page. But then by the end of the month, it's become like 1,000 pages of transactions that you're having to sort through. And that's not easy. It's really, really painful. Big thing is getting API connectivity so that you can sort of scrub the data, scrape that data yourself.
All right. And I got the last question here because I like this kind of down in the weeds thing as a way to end. Can you search them by wallet, see what someone else is doing, or is there privacy?
Oh, sure. Yeah. If you know a Bitcoin wallet address, you just go into whatever your Bitcoin block explorer is and type in that address, and it'll show you all the transaction activity for that address. You don't have a name. You don't know why they were doing what they were doing, but you can see the date, time. You can see who they transacted with. At least that, for Bitcoin, for Ether, for most of these, you can get that level of detail if you have an address. And that's the big thing. Like, that's the first question is like, all right, you want us to track your activity. All right, what was your wallet? What's your address? I don't have your private key. I can't go in and make transactions, but I can definitely go and see what you did.
All right. Good deal. Well, thank you so much, Justin. It's great to have a dual Hokie grad kick us off here for blockchain. Thank you again for being a participant here. It's great that you reached out to our initiative too. It's been great to get to know you a couple of times here.
Absolutely. And any students out there, we're definitely looking for folks. Anybody who's really interested. We don't just need accountants. One of the things that this has forced us to do is we now have to make auditing and tax prep and all that stuff smarter. It's a lot of data. It's a lot of going through data, pulling information out of data. We've been dealing, we're sort of on the cutting edge. We've had to make it up as we go along because nothing was written about it before. So we're happy to hear from anyone who's interested. You can go cohenandcompany.com. Job listings are there. However you want to reach out, we're happy to hear from you.
Right on. Well, thank you again, Justin. We're going to be back in about 5 minutes with our next session that is Justin Daniels and Noah Chong, who are going to be talking a little bit about cybersecurity and ice fishing and how smart contracts, blockchains, and various other on-chain assets are kind of confronting cybersecurity. So looking forward to that starting here in about 5 minutes. And thank you again, Christian.
Sure. You bet.